Morning. Welcome to the market observations call for August 15th, 2022. My name is Eric Jefferson, Managing Partner at Trestlebridge Capital, Chief Investment Officer at Flagship Harbor Advisors. But jumping right in, to recap last week, we had bonds flat, stocks up big, the S&P up over 3%. That was capping off its fourth straight weekly gain, driven by three primary factors. Earnings season wraps up here, continue to have a theme we've discussed all quarter, which is companies have done slightly better than expected. Granted, they've had a very low bar to pass, but have cleared it nonetheless. Secondly, on Friday, got some encouraging sentiment data. University of Michigan survey came out on Friday, 7 percentage points better than where it was the month prior. And then the main headline was Wednesday's inflation reading. That CPI data came in for the month of July at 8.5%. Still a monumental figure, but down from 9.1% the prior month. When you think about headline inflation, two of the more volatile components, food and energy, not surprisingly, where energy costs have come down significantly, that headline number showed improvement. But I think, and arguably the more important figure to hone in on, the core CPI. So if we strip out the food and energy costs, that was relatively flat. Again, obviously would have liked to see some progress there, but hopefully that indicates that inflation has at least peaked, hopefully now trending in the right direction. I think that core figure is arguably the bigger focus of the Federal Reserve going forward when you think about what their rate hike path looks like going forward. Also on Thursday, we got producer price data, the PPI. That measures in essence what companies pay for their input costs. That dropped very meaningfully, down almost 10% from the prior month. That is a very good sign. Again, inflation, it's suggesting that inflation has potentially peaked. Again, the challenge there is as input costs remain elevated, companies have to either pass them along to their end consumers. That eventually will curb demand, or they have to eat those higher input costs themselves. That erodes margins, which is obviously not good for stock prices. Final thoughts, sort of recapping last week. Interestingly enough, the S&P was led by the energy sector, despite the fact that it is up meaningfully this year. There's still, in my opinion, a bull case to be made there. Granted, the summer driving season, which is a tailwind for gasoline, is in the rear view. But one thing to keep in mind, even where oil per barrel has come down significantly from where it was, a lot of companies are still profitable in that low to mid $70 per barrel range. We've seen a few companies report just absolutely monster earnings. And so even at current levels, I would argue those oil companies are still very profitable, something to consider there. The other thing is where the White House has depleted or drained some of the SPR, the Strategic Petroleum Reserve. We are in essence one hurricane away from a refinery or two going offline, seeing a potentially substantial drop in supply. That would obviously put upward pressure on prices. Eventually, too, the SPR will need to be refilled. That's done by buying oil at current market prices. I think that will offer some sort of floor depending upon where prices are when they initiate that replenishing cycle. Also, have been reports out of Saudi Arabia that they are pumping at unsustainable levels. And so at some point, those refineries are going to have to come offline for maintenance. Does that introduce some sort of short-term supply shock? That again would put upward pressure on prices. This morning, got some very dismal economic data out of China that was not unexpected, but has certainly weighed on the commodity sector this morning, particularly oil and industrial metals. We did own China earlier this year. We had bought the dip, however, have since exited that position, following what has been a deteriorating macroeconomic picture. In our strategic portfolios, those are positioned for more longer-term time horizons. We have instituted a series of implementation ideas. So those are getting exposure to companies that disproportionately have stronger balance sheets, more sustainable earnings, and are at more reasonable valuations. Those are all themes that tend to be rewarded long-term. Again, we think with respect to building a portfolio, really three ways to generate alpha. There's that macro risk call. So you're overweight or underweight stocks versus bonds. There's your style implementation. So did you correctly identify owning growth versus value or large caps versus small caps? And then there's implementation, the individual stock, ETF, or mutual fund that you're using to gain exposure to that asset class. Did that outperform its respective benchmark? So think, did your large value ETF beat the Russell 1000 value benchmark? This last trade was really a focus on that last piece, looking for ways to get better implementation or exposure to those regions, sectors, and asset classes that we favor in the current environment. As we turn to the week ahead, I get housing data as well as European inflation. The big focus, though, will be on Wednesday's retail sales report. That is expected to increase 0.2% or 20 basis points from the prior month reading. Again, that ties into that bigger theme of, has consumer demand softened in the face of higher prices? That's a concern if it has. Interestingly enough, retail sales has held on thus far. Certainly a theme we will continue to monitor very closely going ahead. The major headline coming up next week will be the Jackson Hole Symposium. There we're going to hear from Fed Chairman Jerome Powell and the rest of the FOMC. That is a major market event in any year, but especially this year. Hopefully we'll get some clarification on where interest rates go from here. And we talk about having a very divided or lack of consensus with respect to the outlook for interest rates. One narrative suggests where inflation is seemingly topped and trending lower based on last week's CPI report. Does that give the Fed the ability to back off their very hawkish approach due to the concern of going too far, too fast, pushing us into recession? As well, when we think about the debt service or the amount that we have to pay on our national debt, what we've borrowed now at higher interest rates. Then on the other hand, you have a handful of folks that will point to the fact do still have a very resilient, very strong labor market. Does that give the Fed the ability to push harder and further to tackle what, in their words, is an unacceptable level of inflation at the 8.5%? Again, just for some context, long-term average there is 2%. We are over 4 times above that. From a positioning standpoint, with respect to fixed income and interest rates, we're very neutral on the space at this point, particularly over the intermediate term. Same thing when we think about stocks, a lack of consensus. Where do we go from here? What is the next 10% movement? So with that, we do remain fully invested, although with a strong tilt towards those higher quality companies. Again, I don't think this is necessarily the time you want to be betting on those high-flying, unprofitable companies. Just don't know, in a choppy market environment like we've had, those are the names that will get rewarded going forward. From a product standpoint, I'd like to announce we recently launched a ultra-conservative or sort of a cash alternative portfolio. And that's one that targets a 2.5% yield advantage to the T-bill, but with very minimal, if not non-existent, interest rate sensitivity. Again, the concern is if the Fed continues to push harder and further than what the market is currently pricing in, that will obviously have a negative impact on fixed income. This is a way to generate fixed income-like returns, but without the traditional risk facing that market segment. And then in non-investment news, Little League World Series kicks off this Wednesday. Best of luck to the young men who will be competing from Middlebury, Massachusetts. We're certainly pulling for you. That's all for this week. As always, please reach out if there's anything you'd like to discuss in more detail. Have a great week if we don't connect. Take care.